So we're continuing with our example of the average cost method. Now we're going to look at how it's calculated periodically on the periodic system. So I'm just leaving this perpetual system here just for us to see and be able to contrast the difference. But as I said in the previous video, the periodic calculation is very simple. It's not calculated after every transaction, and so therefore all of this detail will not be necessary on either periodic system. All we need to know for the periodic system is two things: units that we ended with. So our ending information is necessary to know, which is the 95, and our cost of goods available for sale is also necessary to know. And so let's just get started with calculating now, because we already know our ending units. We kind of just need to find out what our total cost of goods available for sale is and total units available for sale is. Okay, so we know that our ending units here is 95,000. We need to figure out our available for sale figures. So I'll put all that in the periodic section because it's definitely different from what happens with perpetual. So we need to find out our available for sale units. As we said, that's one of the first things we need to find out. We said that calculating the available for sale is always beginning inventory plus purchases. So for the units, that means that we just have to pull out the beginning plus any purchases that were made for the entire month, because we're doing all of this at the end of the month. And so what we do then is equal to, we have 500 units we started with, plus we purchased 70, then we purchased another 50, then we purchased another 100. And so that means my available for sale units throughout the month was 720 units. And now we need to find out the value of those. So the available for sale value is going to be the values that we calculated here for those same purchases and beginning inventory. So that's going to be equal to now the 5,000 plus the 800 plus the 525 plus the 1,400. And so that's giving me available for sale value of 7,765. And so I kind of have to use this information now. Sorry about that. Just wanted to make sure I could still see the formula. Okay. So under the periodic method, at this point, all I have to do is calculate my average cost. Similar to how we did the average cost for all of these items here, all I need to do is take the available for sale value divided by the available for sale units. And so my average cost is going to be the 7,765 divided by $720. 720 units, sorry. So my average cost is $10.78 is what I calculate as my average cost. So if we have this information, then how do we relate that to what we need to answer, which is what is the cost of goods sold and what is the ending inventory balance for the company. Cost of goods sold we have is cost of goods available for sale minus ending inventory. So that means we need to know what the cost of goods available for sale is. We already calculated that here. And we need to know what our ending inventory is. We know how many units are ending inventory, but we still don't know the value of our ending inventory. So underneath the periodic system, we calculate our ending inventory first. Ending inventory is going to be equal to 95 units times the average cost that we just calculated, $10.78. And so when we multiply that out, we get that our ending in inventory is $1,024.55. If you compare it to the perpetual, it's not far off. That's what, maybe $25 off. So that's not bad. There's always going to be a difference between the two methods because one is a bit more exact. Perpetual is always a bit more exact than periodic. But it's all depends on what the company wants to do and how they decide to buy the inventory. It's small in comparison, and so that's normally not a big deal. Once they pick one, however, they stick to it. So if you're going to use perpetual, you continuously use perpetual. You don't switch between the two. It's just similar with all the other types as well. You don't switch between the average cost method to the FIFO method next month and then go back to average cost. No. Once you select a method, the company continuously uses this method. Unless for some reason they absolutely have to change it. But most times they don't. They just pick one that works and they stick with it. That was a good point. Just a little nugget in there. So, like we said, our ending inventory is going to be the units times the average cost, which is similar to what we did to calculate the value here. Units times the dollar value. In this case, we had to calculate our dollar value, which is the average cost. So that's how we got that. And so now that we have our ending inventory, we can put it in this formula and get our cost of goods sold. So our cost of goods sold would then be equal to our available for sale, the value, minus our ending inventory, which gives us $6,740.45. Compared to the perpetual method, again, it's similar, and it's not that far off. Similarly with the other side. With the ending inventory, it's not that far off. It's okay. Like I said, once the company picks a method and sticks to the method, so it's a pick and stick type vibe that goes on in these companies when it comes to methods for inventory. Okay, and so I hope this helps your understanding of the average cost method, both perpetual and periodic.